Let's take a look at some business news now. Standard Bank reported a 35% increase in headline earnings despite a jump in bad loans. The interest rates in particular have weighed on the disposable income of consumers as they had to spend more and some struggled in fact to pay their debt. Now the effects were most noticeable in the bank's home loan book. Looking ahead, Standard Bank sees interest rates remaining higher for longer despite signs of inflation declining. Nastasia Arendse spoke to CEO Tshabalala for more.
Growth in headline earnings of 35%, driven in large measure by a larger customer base, customers doing more with Standard Bank, was a standout. Secondly, the performance of our operations outside South Africa. They now make up over 45% of our headline earnings, and they were up by 65%. It's quite the 63%, my apologies. It's quite an extraordinary performance. But I have to tell you that it is the culmination of years and years of strategy formulation and build over the last couple of decades. So we're very, very happy with these results.
In terms of credit impairments, I mean, you mentioned that credit impairment charges increased across all your portfolios. Where are consumers seeing the most strain here, if you had to break it down?
So a couple of things to notice. The disbursements, the amount of money we are advancing to people declined in our home loans business, in our vehicle and asset finance business, and in our unsecured lending business. So demand slowed down. That's entirely consistent with consumer confidence. People are suffering from high interest rates, high inflation, and load shedding, job losses, and a very, very difficult environment. That gave rise to a credit loss ratio in our group of roughly 97%, which is effectively the money we take out of our income statement so that we can put it into our balance sheet to protect ourselves against losses that may arise in future. Would you believe, Nastasia, that the balance sheet provisions, the amount of money put aside by Standard Bank for these eventualities is now roughly 62 billion rand. And so it's large amounts of money. Clients struggling and showing strain, but there is light at the end of the tunnel. We believe interest rates will be cut next year by roughly 125 basis points. Inflation will be at roughly 5% during the course of next year, giving the authorities the space to give consumers a breathing space.
When it comes to those interest rate cuts, are you expecting them in the first quarter or second quarter of the year? How are you and I suppose the research team within Standard Bank seeing it?
The differences of opinion about how quickly it'll happen, let's just say it's 1.25% during the course of next year. It's going to be dependent on how quickly the inflation dips below 5.5%.
With that said, in terms of consumers taking strain, what are you seeing when it comes to the pace in which these consumers are keeping up with rate cuts? And also, how are you assisting them, especially in times where you want to keep them in their homes and you want them to hold on to their cars?
Our policy, Nastasia, is, as a general rule, to try and keep our customers in their homes and not to repossess, because we want to keep long-term relationships. The attempts we've made in respect of 20,000 of our customers who are good paying customers, but they're short paying, we've decided to help them in the process of them meeting their obligations. But it is tough out there. As I said, there are some segments of the population losing jobs, finding it more and more difficult to pay when the amount is due, and many people starting to resort to short-term borrowings. We're pretty comfortable, however, that the South African consumer at an aggregate level is resilient, particularly at the top end of the market. People still have secure jobs. They're getting investment income. Middle-income customers are really struggling. And then people at the bottom end of the market of society have got a social security net, something to be proud of as a South African. We've got one of the best social security nets in the world.
I want to take things globally right now. What do you believe to be one of the downside risks to global growth right now?
We've just seen it. Everybody's suddenly read the FMOC minutes. The American authorities, they're actually more bearish and more hawkish than everybody had assumed, and you've seen the market respond. interest rates and inflation remaining higher for longer, interest rates being higher for longer, will have a negative impact on GDP growth. Of course, interest rates are a big input into business confidence, and demand is obviously a big input there too. And therefore, the extent to which interest rates continue to remain high and inflation remains high will have a negative impact on growth.
Speaking of growth, you're expecting real GDP of 0.8% for 2023, and I think you and I can both agree that that is very low. But then again, we are dealing with a constrained environment with lots of challenges. What does the next 6 months mean against that backdrop?
They mean that whilst we've had a spectacular first half as a group, we will continue to have good growth in the second half, but it'll be slower than in the first half. It'll mean that we will see, I think, people continue to struggle to pay their obligations as they fall due. We'll see less volatility, we think, in the markets, which will depress our trading revenues. But we still think that the second half will be a good half. From a South African perspective, there are others who believe that the economy will grow at less than 0.5%. We beg to differ. We think it'll be, as you correctly point out, 0.8%, as the electricity program of the country gets executed faster.